So a pretty boring routine announcement from the U.S. Treasury about debt buybacks actually inadvertently triggered a billion-dollar liquidation event in digital assets.
Yeah, it was absolutely massive.
Right. I mean, Bitcoin just surged past $71,000. That's an 11.5% spike. And it really had almost nothing to do with, traditional retail enthusiasm. So for this deep dive, our mission is to sort of bypass the standard market chatter and deconstruct the exact macro and mechanical and institutional levers that force this specific price action.
Right, because to understand a move this violent, you really have to look at the underlying market conditions before the trigger was pulled.
Okay, yeah.
And leading up to this, the asset's volatility was sitting at a 17-year low.
Wow, 17 years.
Exactly. So because the price was trapped in this really tight, quiet range, traders began betting heavily against it. They were building up these, massive short positions.
Because they just assumed the stagnation would continue.
Right. They figured it was a safe bet.
So that brings us back to Washington. Because the initial spark came when the Treasury announced they were doubling their maximum buybacks of long-term debt.
Yeah, specifically securities with like 10 to 30 years of maturity. They doubled it from $2 billion to $4 billion starting September 9.
Right. So for the listener trying to connect, government debt to digital assets, how exactly does a Treasury operation ignite a crypto rally?
Well, it comes out of yield and currency strength. When the government steps into the market to buy back its own long-term debt, they are creating artificial demand for those bonds.
Which drives the price up.
Exactly. That drives the price of the bonds up, which mathematically pushes the yield, the interest rate, down.
I see.
So we saw the 30-year yield drop to 5.20%. And when U.S. yields fall, holding dollars becomes less attractive to global investors.
Oh, which caused the dollar index, the DXY, to weaken. It dropped to like 98.80, right?
You got it. And a weaker dollar and lower yields suddenly make hard-capped, fixed-supply assets look incredibly appealing as a store of value.
Especially when you add in geopolitical tensions. Like, I know the current U.S. military oil blockade against Iran really spooked the markets. So you introduce a sudden rush of demand, buyers step in, and the price starts to climb.
And that upward pressure is what triggered the mechanical trap.
Like a heavily compressed spring just snapping.
Exactly like that. Once the spot demand pushed the price through a key resistance level, around $66,519, we saw an algorithmic avalanche.
Let's break down the mechanics of that avalanche real quick. When traders short an asset, they borrow it and sell it, hoping to buy it back later at a lower price.
Right.
But if the price goes up instead, they start losing money. Eventually, the exchange's automated engine steps in to protect itself from the trader's losses, forcing a market buy to close out the position.
And that forced buying is the critical mechanism here. The exchange engine doesn't care about the price. It just executes the buy order.
Which pushes the market price even higher.
Exactly. Which instantly pushes the next short seller into a loss, triggering another automated buy order. It is just this cascading feedback loop.
Wow. And that dynamic resulted in like $2.74 billion in forced liquidations. I mean, they saw $1 billion wiped out in a single hour.
Yeah, it was brutal. We even saw a single Ethereum Tether contract liquidated for over $32 million on Bidget.
So the algorithmic engines essentially hijack the market, forcing the price past 71,000. But the mechanics only explain the initial spike. Like, who actually stepped in to hold the line at that new price?
It looks like traditional finance basically took the baton. U.S. spot ETFs absorbed $517.19 million in a single day.
That's insane. And BlackRock alone took, what, $284.7 million of that?
Yeah. They now hold 6.08% of all circulating Bitcoin.
Wow.
And this aggressive institutional accumulation is happening against the backdrop of a sudden regulatory pivot in Washington, too.
Right. The SEC is formally proposing a safe harbor now.
Yeah, which would allow network tokens to shed their restrictive investment contract status, provided the developers actually deliver the promised network utility.
I mean, that is a massive shift in tone. And we're also seeing the White House back the CFTC's efforts to bring offshore, decentralized derivatives platforms like Hyperliquid into the U.S. regulatory fold.
It's all happening at once. Plus, traditional funds like Grayscale are filing to convert older trusts, like their Zcash trust, into a spot ETF, backed by a $110 million investment.
So let me push back a little here. Are we witnessing traditional finance finally, adopting this technology, or are they simply using their immense capital to mathematically corner a fixed supply asset?
Well, I mean, that is the defining tension of this market cycle. Regulators are building the legal on-ramps, sure, but by absorbing such a massive percentage of the supply, Wall Street is fundamentally restricting the available float.
Right.
They are taking the asset out of circulation and locking it in vaults.
So Wall Street is locking up the supply, but what about the miners? The companies actually creating it. You would assume they'd sell into a massive rally like this to cover operational costs.
You'd think so, but looking at the back-end corporate plumbing, they're refusing to sell.
Wait, really?
Yeah. Instead of selling, they're taking on leverage. We are seeing major mining operations collateralize their holdings. Like Miner Power Compute recently posted 307 Bitcoin as collateral for a loan, just to cover Q2 operational losses. They intentionally avoided liquidating their treasury.
Which introduces significant corporate risk. You have major infrastructure companies staring down massive stablecoin debt walls. Like Nakamoto has a $60 million USDT debt wall due on December 4. Are these corporate treasuries building a fragile house of cards by using digital assets as loan collateral instead of holding them outright?
They are essentially betting that the asset's price appreciation will outpace the interest on their debt, but it deeply entangles this ecosystem with traditional credit markets.
Right.
Traditional stock prices for crypto infrastructure companies like Circle and Coinbase are surging right now simply on the hope of new Genius Act stablecoin legislation revenue. The entire back end is heavily financialized now.
And this heavy reliance on financialized plumbing means the base layer infrastructure has to be flawless. Because if companies are managing billions in debt and collateral through digital hardware wallets, a single vulnerability could collapse the whole structure.
Security has always been important, but now it carries systemic risk. A major hardware wallet provider, Bitbox, recently had to push a critical firmware update, patch 9.26.5, after an AI audit uncovered structural bugs.
And zero funds were lost this time.
Right, zero lost. But it serves as a stark reminder of historical software flaws, like that old cold card flaw that previously drained $112.7 million. The margin for error is just gone.
Yeah, totally gone. So let's step back and look at the whole board. We have macro forces triggering algorithmic buying loops. We have ETFs relentlessly absorbing the circulating supply. And we have massive mining corporations refusing to sell, choosing instead to lock their remaining assets in complex debt contracts.
It creates an incredibly tight, highly leveraged supply environment.
Which leads me to this final thought. If the available supply keeps shrinking because Wall Street ETFs and corporate loan contracts are just swallowing it all up, what happens to absolute market liquidity when the next major unforeseen macroeconomic shock hits? If everyone is leveraged and nobody has loose assets to trade, will the market structure absorb the impact or will it completely freeze?